Welcome everyone to the Business Trends webinar. We are going to be focusing today on international tax, the sales tax considerations related to international businesses, primarily focused on businesses that are coming into the U.S. and selling. My name is Shannon Lemon, and I am the lead partner for international tax services at Eide. I have most of my career has been focused on international tax. And I have seen that especially in the last few years, an influx of companies trying to establish their businesses in the U.S. remotely via online sales, but also having maybe bringing also a sales force into the U.S. as well to try to open up that market for them. And what I have found is that most of the time, the biggest hangup for these companies is really sales and use tax. And so I asked Laura to provide us some information related to this and all of the changes that have been happening over this past year. I think it's a timely topic for us, and I will let Laura go ahead and introduce herself as well.
Thank you, Shannon. Hi, everybody. So my name's Laura Robichaux. I am a regional director with the State and Local Tax Group within Eide. I have kind of a very colorful background. I have worked with the Arizona Department of Revenue for quite a few years. I've worked with the Idaho Tax Commission. I have a very strong background as an auditor. I've been in the world of sales tax and corporate tax for at least 10 years. I've lost count at this point. I work with a lot of companies that have a variety of issues, and I function very heavily in the manufacturing and e-commerce section. I also do a ton in construction. I just understand their business model from all my years as an auditor. So that's me. I've been with Eide for about 3 years, and it was great because I transitioned from the Arizona Department of Revenue right into the world of accounting.
Thanks, Laura. So I wanted to, for those of you that are new to Eide or just getting to know us, provide you with a little bit of background related to the firm. We just celebrated our 100-year anniversary a couple of years ago, and so we are a very well-established firm based in our headquarters is in Fargo, North Dakota, and we have offices throughout the Midwest and Western region. As you can see from the map, we cover most of the Western states, and we have just announced a merger with another firm, BTD, which will be joining us in July, and that will add 4 or 5 more offices to our California presence as well. We're a top 25 CPA firm, and we focus primarily on assisting growing companies, primarily privately held, and entrepreneurial spirited, and we enjoy working with the type of business that allows us to provide value to them. Our services are very widely varied. We have about 42% of our practice is in tax, 35% audit or assurance. We have 21% is in consulting, and included in that consulting, which is very important to our client base, is technology consulting. So helping our clients with implementing the technology that they need to grow and move their business forward. So last year, the Supreme Court made a game-changing decision in the South Dakota versus Wayfair Supreme Court holding. The decision allows for the removal of a physical presence requirement on remote sales for sales and use tax. And as states are updating their current Nexus laws, it will have a large impact on foreign inbound sellers. And so those foreign sellers need to consider the sales tax impact of selling into the U.S., regardless of whether they have a physical presence or a permanent establishment. So today we're going to cover a number of areas. First, we'll just talk about, in general, sales and use tax in the context of international planning. We'll define Nexus and discuss its impact on international sellers. We'll also discuss how aggressive state expansions of sales tax collection requirements create filing requirements. and the risk for international businesses working in the U.S. And finally, we'll review the importance of staying in compliance and explore tools that can help with this. So first, on the international tax planning, I always, when I'm working with clients, especially if it's their first foray into international planning, like to talk about this triangle. First of all, we have, we want to consider what could cause taxation from a corporate income tax perspective. There's usually some sort of potential for individual tax implications as well with what they're doing. And finally, and what we're here to discuss today is the indirect tax portion. So in this chart, I'm showing VAT, and that's probably what our outside of the US colleagues are familiar with, but in the US, we focus on the sales and use tax. So sales and use tax is similar to VAT it's similar to the VAT except in its administration. So in general, if you're familiar with VAT, it is collected along the supply chain. So at each step, you collect VAT and you remit the net amount that's due based upon your purchases and your sales. Sales and use tax is a little bit different in its administration in that generally the sales and use tax is administered at the final consumer. It generally does not apply to services, but there are certainly some exceptions to that. And each taxing jurisdiction is allowed to have different rates and rules. And so we, as you know, we have 50 states within the US, but also counties and cities can also levy their own sales and use tax. And so we often talk about the number of taxing jurisdictions, which Laura, I'm not sure if you know the estimate of that, but it is very, very high.
Yeah, actually, I think the total amount of taxing jurisdictions as of last year was over 14,000.
Wow. All right, so that brings us to our first polling question, which is, how do you sell goods into the US? So we have a number of options here: direct sale to customer via your website, a use of a third party, do you sell via a distributor, or perhaps this isn't applicable because you are not yet selling into the US. All right, direct sale to customer via the website seems to be the winner. So this will be super helpful for anyone that is doing that, because what we're going to talk about has a significant impact on those sellers. So with that, I will hand it over to Laura to discuss Nexus.
Thank you, Shannon. So, I mean, this past year has been absolutely done a 180 in terms of Nexus in the US. And Nexus is a term that we use to kind of describe the connection between what is the state says, what are the rules that the state says you have to file and collect in the US. So I won't go through the whole history of it because it's kind of a moot point since the rules have changed now and we're living in like what I call a whole new world post Wayfair. But prior to June of last year, the states really were kind of, I don't want to say handcuffed, but they were very limited in how they could make a company, especially a foreign entity that didn't really have any physical presence in the state or people, or maybe they had one location. They really had a hard time trying to figure out, ways to make those international companies actually required to file returns. We have different levels. So for example, everybody's heard of the IRS. When we're talking about Nexus, we're talking about anything at the state level, not necessarily 100% tied to the IRS. But back in, the early 90s, there was a really strong case that pretty much the Supreme Court said, you can't tell any company that they have to file in your state unless they have physical presence. And physical presence is defined as a person working in the state. It could be a salesperson remotely. It could be, maybe you have inventory that's shipped in. There's huge ports in Texas and California. You have inventory that sits there and gets housed. You have, you bring people over and they perform warranty work and services. So they actually physically enter into the state. So those types of things. What's so unbelievably epic about what happened in the Wayfair case was that physical presence is still a type of nexus, but now there's a whole new rule that the states have adopted called economic nexus. So as of, June of last year, it's just been kind of like a domino effect of one state after another, after another, after another, kind of coming up with these different nexus thresholds. And in a couple of slides, I'm going to start going through those. So there are probably, well, there's more than this, types of different nexus. So physical presence includes under the umbrella what we call agency nexus, click-through nexus, and affiliate nexus. Where a lot of international companies struggle is where they get caught on affiliate nexus. So affiliate nexus is, let's say you have a parent company and maybe you have, 2 or 3 other wholly owned subsidiary companies, and all of these companies either provide a service through the same, line or industry. So let's just say it's repair and maintenance. I'm just making that up. If companies A, B, and C, even though they all have different EINs, they're all separate companies, but they're all affiliated with each other because they're owned by the same parent entity. A lot of states have what we call affiliate nexus, and that means that the state would say, well, if you have one, all of your companies, because they're affiliated, now all have nexus. That's it's probably more prevalent with international companies coming into the U.S. A lot of U.S. companies, they tend to like bifurcate their services to divvy up that affiliate nexus, but it is still very much a way that states kind of catch you. The big thing is economic presence, and we also kind of include that what we call factor presence. And all that means is that economic is based off your revenue. And I'm going to go through some more details about that. But revenue is a very fluid term. Sometimes when my group and I were talking to different CFOs, somebody says revenue, they think bottom line, but the states have a different interpretation. The states have pretty much a top line approach. And what that means is if you did $100,000 of sales into Utah, but 100% of that was exempt from sales tax, you would still have a filing requirement because you still did $100,000 of sales, even though it wasn't taxable or it went to a wholesaler or something like that. So it's a different way of approaching it. Let's do our second polling question before we get into the nitty-gritty details of how it's impacted everybody. The polling question number 2 is, what is the definition of nexus? It's a connection or series of connections that requires a company to collect and file taxes. It's 5 or more connections to a state or region. I have no idea, or it's just another term to describe taxes in general. Fabulous. Everybody was listening. Okay. So I think I kind of drove the point home about nexus. Let's go to the fun stuff. To kind of talk big picture, I'm assuming everyone on the phone is either somehow involved in the finance area, or maybe you're a COO or you're a controller, and maybe you have a U.S. entity or you work for a U.S. entity that's a foreign entity. You're probably wondering like, okay, I know there's a change, or I have heard there's a change, but what does that actually mean? So I like to explain this from an illustration standpoint. So the nexus bubble, the outside circle, it used to be smaller, so just picture it shrinking super tiny. And then with all the new economic nexus rules, it's gotten much bigger. Another way to think about it is, instead of having a very narrow net or bucket, now you have the states have a wider net to require filing. So that's really all that's changed. The same sourcing rules apply, origin versus destination. If anyone's ever had to fill out a California tax return, you know what that might mean. The exemption certificates and taxability, none of that has changed. That's all still the same. And then everybody still has to worry about collection and filing. So it's really just the larger picture of economic nexus, even though physical presence still exists. I get a lot of questions about salespeople and whether they trigger physical presence or economic presence. I also get a lot of questions about repair and maintenance. Maybe it's not your company that comes in and does the repair and maintenance, but you use like a local third party. You deploy a local third party or contract with them to fix something, or who knows what. That even though it's a third party, that creates nexus in a good chunk of states. Anything that you do that affects your customer in the state could potentially have tax consequences. So it really does. I think we went from one side of the pendulum of, well, it's really limited, and now we're like on the total other side of, it's really like wide open in terms of nexus. It's harder to prove you don't have it than you do have it. So this is a great chart that I like to share about economic nexus, and this is from the Tax Foundation, and they're a nonprofit organization, and they, you can go to their website, but they put together different maps, and this is their map for internet sellers. And I kind of want to like clarify that internet seller does not necessarily mean you just sell retail online. An internet seller is software as a service as a company. I see this a lot with tech companies. They anything that you do in the cloud that you charge your customer for could be considered an internet seller, and we're going to talk about that a little bit too in a couple of slides. But this is pretty much anybody doing business. I wish they use a different term, but it's not just internet sellers. It's if you sell anything, it could be a service that could be considered part of your economic presence standard. So this map, and you'll see like, wow, that's a lot of different colors, Laura. What does the green mean? What does all this mean? There is something out there called a Wayfair checklist. If you were to Google Wayfair, you're going to see all different sorts of, I don't know, articles on it and what it really means. The Wayfair checklist means, all that says is that some states have chosen to follow what the Supreme Court said really standardized as economic nexus. But as Shannon mentioned earlier, the US is full of all these different states, and they kind of operate in somewhat of their own country. Arizona, which is where I'm based out of, I'm in Phoenix. We don't necessarily have to follow what Utah's doing, or Colorado, or New Mexico. So the reason why there's variances in colors is that the states have chosen to either follow or not follow the Wayfair checklist. I recently had a very interesting question. So you can see Hawaii down here. And Hawaii is somewhat of an e-commerce state. Hawaii has a gross receipts tax, kind of like a sister to sales tax, that they call it the get tax. And Hawaii has said, guess what? Our economic presence standards don't meet the Wayfair threshold, or excuse me, Wayfair checklist, and we're applying it to more tax types now. We don't have to follow your rules. If anyone is ever familiar with the state of Denver or Louisiana, they have their own what we call home rules. So a lot of very famous cities like Denver, Colorado is a pretty big city most people have heard of. Denver has different rules than the state of Colorado, so they call those home rules. That's why these are marked as red, is because they kind of do their own thing. So this whole map is just to illustrate, since, keep in mind, we're in 2019, in June, July, August, September, November, less than 6 months, all these states had already jumped on board and changed some of the rules. And then, so that's the map in November. Let's look at what the map looks like now. It's full of color. And if in this bottom right corner, this is where I put, I didn't want to put all the different types, but I thought maybe it would be a good illustration of each color, and I realize it looks a little bit dark, represents each state's different type of threshold. So you can look at, the ones in yellow. Those are, they've said we have a $250,000 threshold. Then we look at the ones in, I guess that's a teal color, and we've got red, where they've done different types of thresholds, and this is all their own definition of economic nexus. So what has happened in a year means that all the states said, yeah, we are going to have economic nexus, but we're going to make it to whatever we think the standard should be. So if you have an international company that's trying to do business in the US, or might have one location but is trying to land and expand in a new region or a new jurisdiction, you have to figure out all of the differences between the states, and that it can be really confusing. And this is not all of them. These are just the differences I decided to put on our map. There's actually quite a few more. So it makes it a little bit more confusing. So just to kind of talk about online, and I'll show you guys the chart that we have on our website. That's pretty cool to kind of help navigate through these muddy waters. So for selling online, like I said earlier, this is not just I have something in a warehouse and it gets fulfilled. This includes drop shippers. This includes nonprofits. This includes B2B transactions, intercompany transactions, B2C, what we call business to customer transactions. This really can impact in every side of your business. I think that in the beginning, all of us, sales tax people, we're trying to figure out, okay, how are the states really going to handle it? But this means that if you provide digital content and you charge for it, and I've seen a lot of companies like, well, yeah, we can buy this, and then we just send them a link to a PDF, or you buy something and you get something digitally downloaded, or whatever the case may be. That's considered selling online. The definition is so broad. It's as broad as, I'm doing air quotes, doing business. The fact that it's impacting nonprofits is really huge. And then, of course, anybody that's a manufacturer or reseller, most of the revenue is coming from stuff that's going to be resold by somebody else. So it's really hard to wrap your arms around how this really impacts me as a company, especially if you're trying to come in to the US, or you're trying to enter into a new state and you're trying to figure out, okay, what are the rules for this state? And then maybe you do some processes around that, and then you're trying to figure out, okay, well, I know the rules for this state, but New Mexico is completely different. And maybe you're a company, and a lot of companies do this, where you provide, I don't know, software or a product or some sort of electrical equipment, or maybe it's, technology of some sort. If you provide any sort of like support services, call center services, meeting services, whatever type of like person-to-person service, that is actually taxable in quite a few states, probably half the states, I would say. So I would look at that as, some potential, issues. So when they say selling, they pretty much mean anything that you put on an invoice. Just to kind of make it a little bit more granular so that we can go through this. I have two pictures here of the states. One of them, on the left side, is Washington State, and then on the right side is Utah. So as an example, we have a Washington State company, which if there's any Canadian companies, there's a lot of on the phone. I'm sure a lot of you guys are probably familiar with Washington State's business and occupation, the B&O tax. If you are doing business in Washington and then you decide to, maybe we're going to do one project in the corner of Utah, or we're going to do one project, somewhere in Utah, and then, the contract is $500,000. What the Utah's threshold is $100,000. So I guess the logical question, if you're on the accounting side, would be, do I have Nexus? And you definitely would have Nexus. So the state, Utah, would say, yep, you have Nexus in my state. You've exceeded the threshold of $100,000. We want you to file a sales tax return, and you're going to owe sales tax on that contract. I get this a lot of times from construction people, or if you're in a sales-driven environment where your sales are, for an international company, your sales might be like in Nebraska, and then you might have another one in California, and you could have someone, somewhere else. If it's sporadic like that, the question I get is, well, what if it's just one sale and then that's it? I would say that's a business decision. The textbook answer is the state will tell you, if you exceeded the threshold, you have Nexus. On a realistic side, I would tell you, well, look at it from the sense of what's your risk tolerance, and yes, you exceeded the threshold, but if you are never, ever, ever going to go in Utah again, you might want to look at see what the cost benefit of that would be for filing, because it's not as if you can just turn it on and turn it off. Once you get a sales tax license and you start filing because you have Nexus, it's really hard to separate yourself. These are my two favorite states, which would be Texas and California, just because they seem to be the biggest and have the most resources when it comes to sales tax and Nexus. But let's say that you're an international company and you ship in something in one of the Houston ports or Corpus Christi. You ship some, product or anything into Texas. The ultimate destination of your project is it came into Texas. It's going to California for its final drop. If California has a threshold, it used to be 100,000, and then they changed it. Now it's 500,000. So the question I always pose is, okay, well, if it's less than 500,000, would I have Nexus? The answer is no. So you could have sourced revenue from California because your customers in California, but you don't have Nexus because you didn't hit the threshold. Because I didn't put the threshold on here, I probably should have, but so it does create it. And then it gets even more complex if you have warranty work. And this happens a lot. I think I mentioned it earlier. You're somewhere else and you have traveling people that perform warranty work services, or you repair something virtually over the computer. You could be in India and repairing somebody's computer in California. Under these new rules, California would say, oh, well, that's happening in California. That's a California sale. You wouldn't be able to claim that as a out of overseas sale. So it's different in the way that maybe we've, as international companies have looked at it before, but it's just another consideration to kind of look at. Okay, so let's do a third polling question. The ABC company is renting coffee stations to other companies. Their revenue in California was 800 last year. California has an economic threshold of 500,000. This company does not have Nexus because their sales are all online and there's no employees in the state. True or false? Yes, absolutely. Yes, it's totally false. They exceeded the threshold. They've got to file in California. Okay, good. So best practices. As someone who's worked for the states on the auditing side, I have seen it all. I have seen all sorts of different types of books and records. I've seen, especially companies that maybe you switched your software a couple years ago, so your old system has bad data, but your new system's wonderful. A lot of things that I like to talk about is just keeping clean books and records. And I realize that that's probably a 20-person job in some instances. And when you're an overseas company, your accounting practices might be a little bit different on how like a state would want you to do it. So just keeping really good records in general of anything that you purchase, any sort of invoicing, all of that. It's just so important, and it really reduces the risk of international companies if an audit were to occur. Another suggestion that I think is really important is, especially in today's day and age when the world of business and economy is moving so quickly and technology is at unbelievable. 5 years ago, I would say, we're still probably on like the old iPod shuffle, right? But now in terms of technology, as it relates to sales tax compliance, we've made some leaps. So there's quite a few companies out there that help with sales tax technology. There's different ways that you can incorporate, different sales tax rates into your online system if that's how your business model functions. So I would say don't necessarily think that you have to have a person to do it or a team of 20 people, but there is technologies out there that can make it easier and reduce the risk. Another thing that I always tell, especially anybody that does anything in construction, or you are a construction vendor or anything, is before you go into a new jurisdiction or you're going to make a bid, is look at to see what those states' rules are. Maybe you have to get a bond. Maybe you have to have a certain type of license. Maybe you have to do X, Y, Z, whatever it is. It's just, if there's any accounting people, that the sales people tend to they're running at full speed, and maybe you're like hitting the brakes, like, wait a minute, is the new jurisdictions is really important. We have a lot of international companies that have a huge presence in like New York, but maybe they want to, push some of their operations to Florida because it's cheaper. Look, anytime that there's anything like that happening, look to see if there's any exposure or there's any potential issues. Another thing is talk to the tax department when the bidding happens. Fees, different types of tools and machinery, those can all be subject to use tax, but maybe not sales tax. So it's really important to always price everything out and plan. I mean, those are just the best words of wisdom that I can probably come up with, is just making sure that you do as much as you can, because if like, let's say an audit were to occur, like Texas, for example, they seem to be very audit heavy. If a state were to come in and say, well, we want to audit your books and records, you don't want to go back and recreate something from 2 or 3 years ago. You want to just kind of do it the right way, the whole way across. Here's another thing that I see a lot from international companies that maybe they have a U.S. Entity, is the buying and selling. The economy's been really good. We've had a ton of clients that have decided to sell their business, or maybe they're going to buy a competitor. One of the biggest hiccups that we see is sales tax compliance, and I probably should include also income tax compliance on here, or corporate tax or franchise tax. So if you're thinking, or your parent company is thinking about, yeah, we're going to buy this business, we're going to merge together, this is a 2 or 3 year plan, this is like the perfect time to go in and look to see, does that company you're buying, are they filing everywhere they're supposed to? Are they doing everything from a tax perspective? Do they have any issues on the IRS side? Are they in compliance? Because if they're not in compliance and it comes up during due diligence, it will affect the sale price. So that's always really, really important. And then we see a lot of companies, and we actually help a lot of companies where they're getting ready to sell or they want to go to market. We will help them do what we call voluntary disclosure agreements, which is kind of a way of saying, come clean with the state. And there's a lot of benefits to that too. So how do all these new Nexus rules for international companies and I guess any company in general that does business in the U.S., how is this impacting on the income tax states? On the income tax side. So there's quite a few European companies that I work with that the very common theme is, when we start talking to them about maybe some sales tax issues or state tax issues, they always say, gosh, why is it so confusing here? I'm like, I don't know. They just everybody makes up their own rules, and it's not any different for income tax. So for income tax, what we've got is also economic presence. And this is a little bit different. So we have a sales tax economic presence threshold, and then we also have an income tax economic presence threshold for your business tax. And that's all over the board as well. So I've listed a couple of states here that have different tax. One of the new ones that is not on here that passed about a week or two ago is Oregon. Oregon has now jumped on the wagon, and they will be creating their own gross receipts tax. So that's new for effective 2020. So 1/1/2020. So these are all the other states that are market-based, that for income tax purposes can really impact your company. So market-based, what that means is very similar to economic-based. It's sourcing your revenue for income tax based on where your customer is located. And I also refer to this as, it's wherever your ship to on your invoice is. Ship to is everything. So if you have an accountant, if Eide Bailey is not your accounting firm, if you have an accountant that you give your revenue to, you would need to break it out for income tax by state of where your customer is located. Otherwise, you might not be filing correctly. So this is I'm going to go through this very briefly. This is the sales factor for any companies that actually sell tangible personal property. And in the US, we have these weird rules. It's called throw back or throw out. So what this means is, you could have, for income tax purposes, you could have, your US entity is doing business in Arizona. They have a location here. We just have one simple operation. But maybe they have, quite a bit of services that have been performed in Utah. You would have to look to see, does does Arizona have a throwback or throw out rule? And then how would you throw that revenue? Because sometimes it doesn't get thrown anywhere. This is kind of a complicated concept for foreign companies, but I can tell you that it's a great way for your accountant to look at this strategically to figure out, are you overpaying California? Well, or you're overpaying Arkansas or something like that. So you can look at it from that standpoint. Maybe you're overpaying, maybe you're not. It just really depends. So what have we done with all these changes that have happened? This is a snippet. It's not the whole state, all the states, but it's a snippet of what we have on our Eide Bailey website. This lists every single state that has the economic nexus rules. Arizona, I'm just looking at that because I'm in Arizona and I'm looking at it straight on my screen. Arizona actually did issue Wayfair guidance, so that's going to be coming up, but I think we're at a 97% of all the states have already changed all the rules. So there's a couple that we're hanging on due to legislation, but that's probably going to come through in the next couple of weeks as legislation comes to a conclusion. So we have this chart on our website. If anybody's interested, if you can't, for some reason can't find it, you can email myself or Shannon and we can help get you to that site. And you can always refer to it. We try to keep it as updated as possible, but it's a really good look at if you're a foreign entity that has US operations, you can kind of just look at, okay, where are the big states? Where are the big hitters? Part of our SALT group, what we've done is we've created diagnostics, and we've kind of really tried to take the approach of what might help best, what can best help the client navigate through this. So we have what we call a diagnostic, and that is, it's kind of here's a little snippet of it. It helps identify under the new rules where you might have some issues if you're in a planning phase. So you can kind of see a portion of what the deliverable looks like. We have everything highlighted in yellow. So if you wanted to see if you had any issues with, okay, maybe we've got economic nexus, maybe we've got a filing requirement. We do this for sales tax and income tax because those tend to be more, together than not. So we always try to look at both taxes, and then we create an analysis of, this is where you have issues, this is where you're getting close, you might need to look at this next year, and then so on from there, because it really can change every year. Your footprint, if you are international coming into the US, your footprint can change year over year, especially if you're in a growth phase. So I think this is our last polling question. So the polling question is there more than one way to create nexus in the states? True or false? Yes. Great. I'm glad everybody's listening, and we've kind of like driven the nexus point home. Yes, there's definitely more than one way to create nexus. Gosh, I probably should sit down and think of all the different ways to create nexus and come up with whatever that number is. So just some final thoughts that I always like to leave. Oh, I did put the link in here. Okay, good. So if you have a download or a PDF of the PowerPoint presentation, the file path or web link is in the PowerPoint on this slide. So you can refer to our what we call the Wayfair chart, which has all the economic nexus rules on it. Just some final things for consideration is, think about how these new changes can impact your company, maybe now, but then also whatever your plans are in the future, if you've got a 5-year plan that you're working towards. And then also think about if you start to offer new services or new products, think about how that might be impacted. And then just be open to investing in technology. I don't think that you need to go out and buy something right now, but kind of look to see what you can, if you find that you have a huge filing requirement, go out there to see which one fits best for you and your company and what you kind of want to do. And I will turn it over to Shannon to talk about international planning.
Yeah, I just wanted to mention a couple of things to keep in mind related to international. So as you're dealing with the implications of the Wayfair case, it's a good time to kind of reevaluate things as well. Given the reduction of the U.S. income tax rate via tax reform and Wayfair, does it make sense for you to change your strategy on U.S. presence? And then also, if you are selling into the U.S., Well, there are some times when it's required, but often also just a good idea to be filing a treaty-based U.S. income tax return, which protects you should the U.S. tax authorities decide that what you're doing is taxable in the U.S. Usually it's not, but it's a nice way to start the statute running in case there's some risk there. So we oftentimes will recommend that as well. One other thing which I didn't put on the slide but should be there is if you are selling into the US and you have a related party that's doing some distributing for you or doing the sales function for you. And it's also a good idea to just reevaluate transfer pricing and see if that pricing makes sense, again, from an overall global tax perspective and minimizing risks there. So with that, we are going to wrap up the session. We do want to make you aware of our upcoming June Business Trends webinar series. So here are some of the dates, and of course you can go onto our website and register for any of these coming up. And I believe that we do have a couple of questions that have come in, or at least one. Wanted to walk through those. Let's see.
Do you want me to read it too?
Yes, because yeah, I've lost out.
No worry. So the first question, you mentioned that services are often taxable. Anything on an invoice is often taxable, but are you referring to services provided in the state rather than outside the state to a company in the state?
That's a tongue twister. But yes. So services, when I say that services are often taxable, I'm referring to any service that's provided regardless of where it's provided. So if you're in Canada and you're providing a service over the phone to somebody who is in California would say that that is a California sale and the California rules apply. Now, California doesn't tax services, but hypothetically they could. So that, I hope that answers your question. And the way I think about it is where is your customer? Everything is going based off of where is your customer located, not necessarily where you are located. And that's the hard part when it comes to international companies, is because a lot of the stuff that, business that is happening overseas, but to a US state like California, they would say, nope, all that's considered California income and we want you to file a return. So yeah, I hope that answered your question. If it didn't, please feel free to type something, or you can email me directly.
All right. If anyone else has any questions, you can go ahead and use the question and answer box. Laura and Shannon, we do need to fill 2 minutes just to meet the CPE mark. Can you provide us with anything?
Sure. I'm trying to think. Laura, one question I wanted to ask is, what types of software are being used to sort of track and manage some of the sales and use tax obligations? Maybe you could touch on that. Is that something that's incorporated generally into the accounting system, or is it a separate type of system?
So there's what we call front end and back end. So you need the front end accounting software. We call it an API connector. So let's say you're a company that allows people to place orders online. You need a front end software to correctly calculate the sales tax based off of location of the ship to address. And then there's also the same type of software companies provide what we call back-end services, which is compiling the information of where you've collected sales tax and then remitting it to the state. So there's a couple of pretty big players in that space. One of them is Vertex. I believe Amazon uses Vertex. I'm almost positive that they do. Vertex is a huge sales tax solution software. They have API connectors that can pretty much hook up to any what I call off-the-shelf software. There's Avalara is another one. TaxJar is great if you're e-commerce. Thomson Reuters, Walter Coolers, they've got all different types. There's some pretty big players in there, and it's not going to break the bank in terms of when you think, okay, I need to hire 1 or 2 full-time employees to handle this. But what I will say is that it's really hard, especially with the technology, if you have like a homegrown system, which means it's something that you have internal programmers that created the system, and it's super custom and it's really closed off. That's harder to connect to with these sales tax technology solutions. It's not impossible, but it takes a longer time to connect versus if you were to buy, it's off the shelf, they just literally download it, plug and play, poof, you're done and you're ready to go. But there's some really good online platforms, like I call them shopping carts.
Okay.
If you wanted to ever figure out, hey, maybe we want to launch this, or we're going to start selling stuff online, there's some pretty good shopping carts too.
Great. We did have a couple of questions come in while we were talking about software. This one is just a follow-up to the last one, which is, so you are saying that services might create Nexus, but not necessarily be taxable?
Yes.
Okay.
And that is absolutely, and that is the pain point, because you could do $1 million in Washington State on all, well, that's a bad example, let's just say Idaho, and services, your types of service isn't taxable, but because you've exceeded that threshold, the state would potentially say that you would have Nexus.
Okay.
Generally speaking, that's how it would work. So from a business standpoint, what does that mean? It means that you have to file what we call a zero return. You have a filing requirement, but there's no tax due.
Okay. Great. And then the last one is, what would be the best way to learn of a change? And I presume that means a change based on, the changes that are happening with Wayfair in each state, sort of making changes to their thresholds, et cetera.
Sure. There is a lot of resources out there. I would say that if you're thinking, if this is about figuring out if a state has a new rule, it's hard for even tax consultants to keep up with that. We purchase and utilize different technology tools because we can't go to every single state website and look at the new changes. We use certain research companies to help us pull that information, especially anytime there's any legislative changes. But I would say, there's probably a couple really good ones that you can ping to most of the time. Our website, we try to push out as much new content that you may need to be aware of as possible. Other than that, I have some clients that in the states they're really worried about or they're scared of, they subscribe themselves to the state newsletter so that they know if any changes have happened, because states do push out newsletters. There's all different types of tools you can use. I mean, if you're very industry specific, I would say that there's probably other associations that can push out tax news to you as well. Or if you have an accountant or a trusted advisor that you really confide in, maybe they can help you too.
Yeah, I would just add to that one thing is that I have the chart that you noted bookmarked, and so that would be something you could just check that on a regular basis. And then secondly, if you're an Eide Bailey client, we can sign you up for our tax news, and so these types of items would come through on those emails, which are usually at the most weekly, just because we don't want to bombard people. But those, if you want to get signed up, you can certainly contact the person the service provider that you work with Eide Bailey, and they can get you added to the newsletters for tax. All right, I think that will cover it. I don't see any other questions. Thank you, Laura, for providing us some information related to these very complex rules and how they impact international companies.
Sure, absolutely.
Thank you guys so much, and everyone have a great weekend.